Hello everyone, welcome back to my channel. So this video marks the wrap up of week number 11 in this Road to 200k challenge, and this week was pretty different to what happened in the previous ones. Basically the markets were much more sedated, and apart from one or two large fluctuations which were relevant to us according to the stocks in our portfolio, nothing relevant happened. And as a result of that, all the options that we sold on Monday, at least the ones that we still held during the Friday night, the time that they expired, they all expired worthless, and so nothing has happened. I was not assigned any stocks to buy, and so basically, yeah, it was all profit, and so we had nothing in terms of potential losses, in terms of having to be assigned stocks to buy and then to potentially to have to sell them at a later stage. And so this is basically what happened during the week. And to give a little bit more detail, on Tuesday, and so this was a little bit more to the end of the day, American Airlines had accumulated a large gain over that trading day, and so because of that, these puts that we sold on American Airlines became basically worthless, and so I decided to buy them back at the price of 1 cent. Unfortunately, I was only able to sell one of them, one of the seven that we had sold with a strike of 10.5, as you can see right here. So even though I tried to buy back all seven, we were able only to buy one during Tuesday, but the other ones we were able to buy them back by Wednesday, by the next day. And so we used the collateral that was released to basically sell additional puts on Lyft with a strike of 12 to add up to the ones we have already sold, the 10 we already sold on Monday. And why is that? Because in terms of the profitability of the potential trades that we were considering, namely selling puts on 4 or basically or on American Airlines or with another strike, none of those possibilities were as profitable as the Lyft, and so I decided to go ahead and sell more puts on Lyft with a strike price of 12, again with the same purpose of trying to lower our average price so that we can sell them at a lower price and still breaking even, at least on the price. And then also because of this increase in price that continued to occur on Wednesday, the call with a strike of 13.5 became available to be sold, and so I decided to go ahead and try to sell 9 calls with 13.5. Keep in mind that I would still have a small loss in terms of price, because by selling at 13.5 I would have an average loss of 22 cents per each stock. But however, the price that that I needed to sell these stocks, given the fact that I already received some premiums on it with the calls that I sold in previous weeks, I would still come out of this trade with a profit, with a capital loss, but with the premiums more than offset that loss. And so I decided to go ahead and try to sell the 9 contracts because we have 900 shares, as you can see right here, as I tried to sell 9 contracts. But by the time I input the trade, there were only 4 contracts available at that price, at the price of 2 cents, and so the other ones would have to be sold at the price of 1 cent. And I decided not to do it because I would still have to pay fees or commissions on the trade, and so the price of 1 cent probably would not be enough for me to still have a profit. And so I decided to leave it as is with these 4 contracts and not lower the price, and especially because the price of American Airlines stock at that point started to fall, started to correct from the large increase it happened, and so the calls became less valuable, and so the price never went back to the 2 cents. And so yeah, I decided just to stick with the 4 contracts we sold until maturity and not sell any more calls on it. But then as time went by, and this was on Thursday, it became apparent that this call, these puts that I sold with a strike of 11 would not become exercisable, and so the price went down to 1 cent. So I decided to bought them back and sell and use the collateral to sell more puts on Lyft, because basically the premium was pretty good given that there were only 2 days until maturity. And so I went ahead and sold more puts on Lyft, which, given the price that they were selling at the time, the stock price they were selling at the time, and the fact that on Friday, for some reason that I did not try to look for the justification for that, but the Lyft stock had a pretty impressive increase on Friday, and so those puts with the strike price of 11 expired basically worthless. And at the same time, I was hoping that perhaps it could go a little bit further in price. The price would rise even more, even though it was very unlikely that the price would rise to the strike that we had sold previously. But yeah, it's not in here, but I had a call it says in here. We had a call with a strike price of 14.5, which was the average price of acquisition for Lyft, as you can see right here. But of course, the stock price did not reach this strike, and so the stock basically expired worthless. Nonetheless, this is how the trades went. I recall that in the case of SLOD, we sold the 8 call contracts on Monday with a pretty good premium, because the price was very close to the 98 strike price that I wanted. Yeah, I'm really looking forward to sell this stock, basically because we are approaching the earnings on October the 31st, so to avoid this volatility event, it would be nice to get rid of it. But as you can see here, we collected a pretty hefty premium on Monday, but then after I sold the call, there was a gap here. The price basically crashed, and the calls basically became very close to being worthless. However, because I really wanted to sell the stock, I decided not to buy back the calls and potentially extend the maturity for another week to collect more premium. I decided to stick with it, and over the next coming week, over the remainder of the week, apart from this large fall in price, the price went continuously going up. And yesterday there was also a pretty large increase in price, even though a little bit more of a correction towards the end of the day. But this at least gives me a good possibility to be able to sell this. For some reason the option chain is not showing, but let's try this way. Yeah, that's good. and if the price remains as is when the markets open on Monday, it will allow me to collect more of a good premium. You see, this is a pretty good premium for this stock, and so yeah, this is basically the call I will be selling on Monday. And so in the end, even though it was not exercised, the call expired worthless. It offers me still a good possibility to continue to collect more premiums, juicy premiums on this stock. But basically, this was it for the week. And yeah, in terms of the 4, nothing happened, although there is also the concern. Not only Lyft are already scheduled to release their earnings, but 4 is also has also its earnings on October the 28th. And for me, I'm especially concerned because this is a warning sign for me. As you can see here, and we are talking about the option contracts that will expire at the end of next week. As you can see right here, the option chain is very, very shallow. It's not deep, and so there are because the stock is seen as is considered as having low volatility traditionally. There are not a lot of options available when the price goes a little bit more away from the current stock price. And so this is a warning sign, because the potential that we have to acquire stocks at a much lower price, given the fact that the historical volatility is relatively small, 29%, it gives us very, very little scope to be able to trade options in a way that allow us to lower our average price. And so yeah, this is going to be a tough one to get rid of until October 28th. What I'm probably going to do is, on this week of October 28th, I'm not going to sell any puts on this stock. I'm going to wait for the earnings, and if the market crashes, if the stock crashes, then I will, after the stock price comes down, then I will sell the puts, and we will see if I'm able to collect some stocks at that particular those lower prices, so that then we can average down our price of acquisition, and then we can sell when the stock eventually recovers. But we will have to see. Yeah, but this is a concern of mine, especially this one more than the other ones, because of how shallow the option chain for Ford Motor Company is. But yeah, this is a challenge that we will have to cope with. We'll see what happens. For the time being, let's just input our trades in our scoreboard. So this was the last trade that we did on Monday, so this is already there. So all the trades start here. And so basically, as we can see, we bought back these American Airlines puts. All right, we bought back 7 of them with a price of 1 cent, and we basically paid $2.88 in commissions. All right, so, and these are the 10.5 calls, the 10.5 puts rather. I separated them, yeah, because yes, now I remember, because I sold them I bought them back in several separate days. So let's address this one first. 106 in fees, and I bought them back at 1 cent. And this basically was on October the 8th. All right, so this is it. 08. All right, and this was bought back. This is closed. Now, yeah, this is it. Let's just drag this formula right here. All right, yeah, this is it. All right, as you can see, of course, this is a very, very good return, obviously because this trade only lasted for 1 day, and so that is why it was so profitable. All right, this next one was on the next day, on October 9th. All right, and here it was 1.82 in commissions. We bought back at 1 cent, and the trade was closed here. Of course, here, because it lasted 1 more day, the profitability, the return of the trade was a little bit higher. On annualized terms, a little bit lower because it was over 2 days, but still, it's a very good return. All right. Now moving on to the next one. Still on Wednesday, as we mentioned, we sold these lift puts, and we also sold these American Airlines calls. Let's start first for the American Airlines calls. All right, so basically let's do this at the 9th, again expiring on 11. This was an American Airlines stock, American Airline covered call. By the way, this expired worthless, so we can put already this in here. Strike price was 13.5, and these were only 4 contracts. All right, and so one thing that we can do here, even though this was not the actual price, but we can do this in this way. Let's look for it. I've already selected the cell in which I'm going to basically put this trade, so then we can see what is the price I have to sell this stock so that I can break even, including the premiums. So basically, this is wrong. All right, so my mistake. Yeah, my Excel skills are letting me down this time. Right, so this times this, and plus, oh my god, are you letting me down? This, and then plus this times 100 times this. All right, so this is it. This is the actual collateral. All right, let's just ignore this error because this is not relevant. And here I remember that I sold for 2 cents each. Let's see the fees that I paid for it, and the fees that I paid was 286. Right, 286. Again, these expired worthless, so nothing happened. Right, and as you can see, the return was meager because the premium was very low. So yeah, that is a problem that we have to cope with. But nonetheless, just as you can see here, if I sold these stocks, these shares at 13.50, I would still make a profit considering the premiums, because the price I would have to sell to break even overall is 13.42. So yeah, if it worked out, I would still be happy, but that didn't happen. But whatever. So, and then moving on, we sold these 6 puts on lift. All right, with a strike price of 16, strike price of 12 rather. Right, this is it here. This was a cash covered put with 12. Right, here was 6 contracts, not 10, and the price that we got, the premium was 22 cents, and the fees were 4.24. So 4.24. 22 cents. All right, this is correct. Now, of course, these expire worthless. So this was also a very, very good trade. As you can see the return right here. This, and why is that? Because Lyft has now an implied volatility which is very high. Traders are basically pricing these now with a very, very juicy premium, because of course when earnings are coming they build up the premiums, because there is it is a volatility event, and so options are more actively traded, especially the put options, because of being traders are afraid of a large fall in price. Yeah, so we are smiling now, but the pain is coming in later basically. And so on Thursday we sold these American Airlines puts. All right, we bought back actually at 1 cent, and here we had a credit of 145, and then we had to pay 63. So 145 with 60, it would be 85 cents, but now it's 88 basically, if my memory is right. Let's see here. So this is 0.63 minus 1.45, 82 cents. I said 88, I think, yeah, but yeah, it was wrong. All right. So minus 0.82. Oh, this is not correct actually, because it's not in here. So it was these American Airlines puts. This was bought back at 1 cent. Not sure why this is happening here, but we'll take care of that. So basically this is it. Right, this is 10. Here. Let's just drag this thing here. Right, so yeah, this was closed. Right, this is, I believe this is correct. Yeah, 1 cent. All right, this is good. Yes, this is correct. So as you can see here, also a very good return, given the fact that this put was had a very, very juicy premium, as you can see here. And so basically we were able to release this collateral. We sold 4, 5, 6, 7 more puts on Lyft with a strike price of 11.5. We did not go for the 12 because the 12 at the time I already had 16, and if they were exercised there was a risk of having too much stock with that particular price. I prefer to use a more progressive approach, a laddered approach. And so basically I decided to do that in a different way, in a more progressive way rather. And so I decided to compromise a bit on the premium, but being able to try to get stock lift of the Lyft stock on a more competitive price of acquisition. So I believe these were 10 cents if I'm not mistaken. Yes, and let's see what the commissions are. So this is 45 plus 105 is 150, so 378. This is basically 328 if I'm not mistaken. Yeah, 328. Yeah, let's just confirm. So this is 45 cents plus 278 plus 0.05. Yeah, 428 exactly. So that's 428. And let's put this right here. All right, and these puts also expire worthless. Also very good return on annualized terms. And yeah, basically I think this is it. All the trades were input, right? Yeah. And so everything, as you can see here, all the rest expired, worthless. So we basically collect everything. So now we close out this trade that came from the other week, which was the calls we had on lift. They expired. Of course, even though the trade was pretty good on itself, on annualized terms, much worse because the trade lasted 10 days, but it is what it is. So these covered calls on SLOD also expired, worthless, expired. Again, of course, almost 1,000, but 1,000 in premium, but keep in mind that the collateral that I had on this was also pretty high. So yeah, that's the reason for that. But basically there is nothing to do here. Right, all of these expired, worthless, and so basically we collect everything. Also here, let's put here, all these trades expired on the 11th. All right, and so as you can see here, now even though we bought this stock at 97, now we could get rid of this stock at 95.37 and would come out breaking even. This batch of shares that I bought with 96, I could get rid of them at 91.41 and breaking even. And the other batch of shares which I bought at 100, this one is still OD, yeah, basically I could sell them at 94.19 and would break even considering the premiums we already received. And so this lift stock as well, even though I bought them at 14.5, I could get rid of them at 13.52 and would still break even. And lastly, as I mentioned, these American Airlines shares were bought at 14. I could still sell them at 13.42 and would still come out breaking even. But for the time being, this is it. Of course, nothing was sold, and so we keep collecting the premiums, not considering the mark-to-market losses that are in there, which are no longer relevant. We are almost 12,000. We are 12,000 almost up on this campaign. But yeah, basically we will need to see what happens. Of course, now this is correct because of the formula. There was probably one mistake here with the formula, but still a very good return nonetheless, as you can see here. So not considering the losses, the mark-to-market losses, which are mostly irrelevant at this point because the prices are all now different. We are almost 12,000 up, and we are still having to cope with unrealized losses of almost 4,000. So I would say this has been a pretty good campaign nonetheless, but of course we are still hoping to get rid of all of these shares and continue to recycle the buying power we have, selling more puts, and then once we get a sign, selling calls to get rid of them, because this is basically the strategy of the wheel in options trading. But for now, this is it. Feel free to leave your comments and suggestions below, and also of course feel free to like the video and subscribe. I'm also available on LinkedIn in case you have any comments, any questions, and yeah, you may basically, if you want to reach out. And we'll reconvene on Monday for the start of week number 12. Until there, yeah, have a good weekend, and I'll see you all next time.